So let's kick off the day with some theory. So this paper is joint work with my colleague at the University of Toronto, Charles Martineau. And we're going to talk about analyst coverage. And in particular, interest in this topic was piqued when we saw how unevenly distributed analyst coverage is. For example, a company like PayPal would have 42 reports in a given quarter in 2017 at the quarter 4. Amazon would have 39 analyst reports, whereas older established company like Ford will only have 12, and the average S&P 1500 will have 4. So what's generating this huge cross-sectional dispersion, right? You have these huge winners, whereas the average stock is not really well covered. So looking at the facts, analyst coverage is indeed crowded. The top 5% most crowded stocks actually have 20% of all the analyst earnings reports, which brings a couple of theoretical questions. First, is the information supply really optimally distributed in the market? Is that the way we want analyst coverage to split across in the cross-section of stocks? And second, if we do have excess clustering, how should we wrap our hands around it? What drives it? So we're going to build a model, and this model will have both endogenous demand of information and endogenous supply. So investors will acquire signals that are provided by analysts in some sense, and the analysts are going to make a strategic decision about which stock to cover, right? So the demand will drive the supply, and the supply will drive the demand. So in this sense, we borrow a lot from the literature. Obviously, on the information acquisition side, we have this concept of limited attention of investors that we borrow from Van Nieuwenberg and Belkamp's the Restat paper. And analyst coverage will have career concerns in some sense, and they will strive to maximize the share of investor attention that they can gather. So putting this together, our contribution is to sort of claim that the clustering is actually driven by strategic complementarities, which are driven by the limited investor attention. But first, I'll start off with some very stylized facts to see that clustering is indeed an issue. We're building a very simple, straightforward measure of analyst coverage crowdedness, and it's very straightforward. We're just taking the number of forecasts from analysts for a particular given stock and quarter, and we're dividing it by the sum of all the forecasts in that quarter, right? So that gives you the weight of a particular stock in that quarter's coverage. And we understand that kind of this crowdedness can be driven by a number of factors. So we are controlling for the size of the company, we're controlling for institutional ownership, for the age of the firm, for turnover, for volatility, industry fixed effects, year fixed effects. So we're really taking out the residual. And we're doing this over a fairly long period of time, from 1985 to 2017. And then we are interested, how does the distribution of this residual look like? And we see some very fat tails, right? In the universe of all stocks, but also across S&P 500 stocks, right? We're benchmarking this, we do some Q&Q plot with the uniform distribution. We understand the uniform distribution is not perfect, but it's a benchmark. Once we control for everything else, we don't know why a particular stock should have more coverage than the other. And we still see these fat tails, even for S&P. Now, we go one step forward and say, okay, does investor attention have anything to do with this? So what we're taking the analyst crowdedness measure that we compute, and we are regressing this on lagged investor attention. Here we follow the RFS paper of Ben Raphael, Dan Israelson, and we're looking at click on Bloomberg terminals. And we see that even after we control for size, industry, firm age, volatility, there seems to be a positive correlation between investor attention in quarter T-1 and analyst coverage in quarter T, right, in the next quarter. So it seems that this analyst crowdedness responds in some sense to what investors are asking for. So now taking a step back with this stylized facts in mind, we're wondering, okay, what can be the economic channels and what can be the economic implications of clustering? On the one hand, I'm thinking, well, my first thought when I saw this data was this should be some sort of misallocation, right? If you think that analysts are a scarce resource, their computer power, their brain power, is it really the case that having the 39th report on Amazon or the 42nd report of Netflix add much value, right? And Charles and I are actually working on a project to establish that. This is all the more baffling. 18 companies in the S&P 500, right? These are fairly large companies, had no earnings forecast at all in the last quarter of 2017. So is this the way we want to allocate analysts to cover different stocks? Now, on the other hand, this could be just a demand-driven effect, right? Because investors have limited attention and they can't invest in everything. Van Nieuwenberg and Velkamp show that with limited attention, they will be optimally under-diversified. So maybe investors make a conscious choice to direct attention to particular stocks, and analysts are simply catering to what investors want, simply selecting those stocks. So it could be optimal, right? So we're trying to build a model to sort of see where exactly are we more likely to stand? Is it a misallocation, or is it just what investors want? So we're going to build a fairly straightforward model. So this is going to be a noisy rational expectation equilibrium model, as in Diamond and Verrecchia or Goldstein and Young, with some elements of endogenous supply from analysts and limited attention. So to keep it simple, we're only going to have two risky assets that pay off at the end of the game at time 2. And we're going to dub this a high precision asset that's going to have a precision tau VH, or a variance of tau VH minus 1. And the low precision asset, which is going to have a higher variance, is going to have more risk, and it could have a lower precision, right? And you're going to have a risk-free return normalized to 0. We're having 3 types of agents in this model. We're just going to have investors. These investors are pretty boring. They just have 1 unit of cash. They have Cara preferences over the wealth at the end of the game at time 2. We're going to have 3 stock analysts. The numerical simulations show that the result generalized if we have more, but 3 actually allows us to get some nice closed form solution. So the stock analysts cover one of the 2 assets, right? They have to make a choice. They cannot cover both. They have to specialize. And finally, we're going to have noise traders, because we're going to have markets clearing, and because we don't want the price to be fully informative, right? We want to have some sort of rationale for information acquisition. We're going to have noise traders in this model, and they're going to submit a random demand function, normally distributed, which means 0, and their precision tau x, or variance tau x minus 1. Now, we're going to have learning in this model. So each investor, J, can acquire signals, right? Can acquire signals about both assets, and these signals are going to be equal to the true value of the asset plus some random noise, with a precision tau epsilon, right, for asset I and investor J, because each investor endogenously can choose signals with different precisions. Now investors cannot acquire infinite precision signals, right? They have a limited attention, which we're modeling as limited learning capacity, right? This is a constraint on learning. We follow Van Nieuwenberg and Velkamp here. The weighted sum of signal precision has to be lower than K. And our sort of innovation in this model is to add this weight to the learning capacity. That's phi I. And the phi I essentially is the shadow cost of learning about asset I. And this depends on the information supply. This depends on how many analysts actually cover stock I. The more analyst coverage, the higher the number of analysts that cover stock I, the cheaper it is to learn, right? The more this constraint is going to be relaxed, and you can actually acquire signals of greater precision without using up the capacity. So we are taking the simplest possible functional form we could think of, and just said phi equal to 1 over ni, right? 1 over the number of analysts. And you should know that 1 over n essentially implies decreasing returns to scale. The more analysts you have, each additional analyst is going to bring less value. So the analyst itself will have a problem, right? They will have to choose which stock to cover, and they will do so to maximize the share of investor attention, right? So if you look at the sum, each term here is the share of the capacity K that's allocated to asset I, and each analyst will have to share it with everybody else covering the stock, right? And we're going to assume that they share it equally. So the analyst will have to choose a stock that maximizes their attention, and that's consistent with maximizing trading volume in that stock, bringing business to the brokerage house. How do we think about this constraint and analyst coverage? Well, we're looking at it a bit of a data compression. So imagine that everything you can know about a company's earnings in a given quarter can be visualized as an array of bits. In this case, like 16 bits. And you can think of each bit here being a line in the balance sheet or in the profit and loss, or something about ordering balance, or a Twitter of the CEO, etc. And in order to process all this, you can do it by yourself. It's going to occupy a lot of your time. Let's say, the best forecast is by adding up all the numbers, seeing how many ones you have. So that's where analyst comes. Analyst A will take out part of this information and process it. Analyst B will take some other part of the information and process it, and they're going to compress it, right? After analysts A compress it, you essentially have to read the report and look at the rest of the information. After analyst B is done, you have 2 reports, and maybe there is some information that you might want to process yourself. But overall, you are much better in terms of capacity that you're using. Okay, so how our model goes? Well, at time -1, the analyst will choose what stock to cover. It's either stock H, the high precision probability alpha, or the low precision probability 1 minus alpha. Then the investor will see essentially the cost of the shadow cost of learning. They will acquire the signals. They will submit the demand schedules, then the market will clear and everybody will get their pay. Now, the market clearing part, it's quite straightforward, right? It's just a noisy rational expectation equilibrium. The demand from each investor is going to be essentially the expected return, so the expected value of the asset given the information contained in the clearing price and the information in the signal you just got, minus the clearing price, divided by basically the risk aversion and the variance. The markets will clear, right? The sum of these demands plus the noise traders, they have to equal to 0. The assets are all in zero net supply, and we're going to get a market clearing price, which is going to be linear, and it's going to depend on the 2 random variables in the model. That is the true value of the asset P tilde and the random demand, the noise trader demand X tilde. Now, if you think of price informativeness, now after the market has cleared, how does the investor change their posterior, right, of the asset payoff? Well, the posterior precision of the asset payoff is going to be the prior, how much you know, plus how much you learn by your own signal, and how much information is contained in price, right? So when you learn as an investor, you have to take into account that not only you know something about the asset, but you're revealing something to the market by trading, right? Your signal is going to be contained in the clearing price. Now you can define price informativeness essentially once you solve for this row in equilibrium as essentially the precision of the noise trader in demand, loosely speaking, scale with the risk aversion, right? If this tau x is low, is 0, then the noise trading demand has very low variance, which means the price is very informative, right? There's very little noise trading going on. Now, looking at how investors allocate attention, right? Let's say you start, so this is a maps precision in the low precision asset, high precision asset, and these are the priors, right? So once you learn, you can move the posterior, say, here or here, and where it's optimal for you to move your posteriors depends on the actual coverage. So let's look at the blue lines. The blue lines correspond to a case where one analyst is covering stock H and two analysts are covering stock L. So that's the straight line here. It's your capacity constraint with a slope that's given by the relative cost of learning. This is your utility function, and you're going to learn this much about the asset, right? So the precision of asset L is going to grow a lot, and the precision of asset A is going to grow a little bit less. If you switch one analyst from L to H, you're going to learn a lot more about H because it's better covered, it's easier to learn, but you're going to learn less about L, right? Because it's less well covered right now. Now, how are the investors going to allocate the attention? Well, we decided to look at the capacity that they allocate. And the easiest way to think about them is to interpret them in terms of deviations from the average capacity, right? Let's say you learn about M assets, you might not learn about anything. Then you're allocated K over M, right? Sharing your attention equally across the M assets, plus some deviation. And when is this deviation positive? When do you want to learn more about the assets? Well, you want to learn more about stocks that have higher asset uncertainty, that have a lower ex-ante precision, about stocks that are better covered because it's actually easier to learn, and about stocks for which the price is less informative, that have more noise trading. Because if they have very little noise trading, then you know that what everybody else learns will become available to you through the price. So you want to learn more about stocks where the price will reveal to you less. So this gives rise to three channels, three main economic channels when you move to the analyst decision. First, you have strategic complementarities, and that's sort of the main argument of the paper. Investors will learn more about stocks with better coverage. It's just cheaper for them to read those reports once they're produced. So it's optimal for an analyst to join the hype and produce a report about something that's already well covered, because that's what investors will care about. You have differentiation incentives, right? In some sense, if a stock is very high, then you can become a monopolist if you're covering a stock that basically had zero analysts before, and then you have information spillover. If more analysts cover a stock, then the price will become more informative. So maybe it's good for you not to provide more information there because it's already available for free in the prices, all right? So looking at the equilibrium, well, we're first going to define this clustering variable, which is a function of the probability of covering stock alpha. You're going to have three regions for the equilibrium. When capacity is low and the assets are actually very close in precisions, analysts can either cover H or L, but they're going to be covering this in pure strategy. It's simply going to be a coordination game. As capacity increases, you're only going to cover the low precision, the more risky asset, and capacity increases more, analysts would cover both stocks. And actually, the more capacity the investor has, the more equal the analysts cover, right? So a lot of clustering is going to be when capacity is low, and the investors really cannot learn about both assets, right? They have to focus on one, and that makes the analysts focus on only one asset. The more capacity they have, the more investors' constraints are relaxed, the more the information is going to be like equally shared. Now, if you have more noise trading, you actually stimulate coverage clustering because you're limiting the informativeness of prices. If you have very informative prices, then analysts will essentially not have an incentive to cluster because the price will actually reveal the information already. Is this optimal from a investor's point of view, where we're thinking of what the optimal clustering is as maximizing the investors' welfare? And what we find that if you have high noise trading, then you can have excessive coverage crowding in equilibrium, right? You have an optimal level of clustering, so that's the demand-driven part. That's what the investors would want. They would want some level of coverage, but the strategic complementarities actually make analysts cluster much more than that. On the other hand, if you have a low level of noise trading, you may have insufficient clustering, and that's because analysts are shying away from stocks that are well covered because they think every other analyst information is going to be contained in the prices already. So their marginal contribution is going to be little. They would rather go to other stocks where the information from analysts is not contained in the prices. And that will actually lead to an inefficient subclustering, right? But for high levels of capacity, you're again back in the level of excessive clustering. So, by making information easier available to the investors, you're going to run again in this problem of excessive clustering. So because I have less than 1 minute left, let me wrap up. So I hope to have convinced you that empirically, we have a crowded analyst problem. The top 5% US stocks have 25% of the coverage. It seems empirically to be driven by limited investor attention. It persists even after we control for things like size and industry and institutional ownership. And our main challenge is strategic complementarity. If investors have limited attention, they can only focus on particular stocks, and analysts have this incentive to coordinate on those particular stocks, which are primarily the ones with ex-ante higher risk. Now, if prices are less informative, there's more noise trading, then that leads to even more clustering. And typically, as we increase the capacity, as we relax the investor constraint, we're not solving the problem. We're actually having more excessive clustering. Even though clustering goes down, it goes down slower than investors would really want to. All right. Well, thanks so much.
Perfect. You have 10 minutes.
All right. Thanks, Bjorn, and welcome everyone. I'm excited to be at this conference. It is right after my MBA teaching, so please forgive me if my brain is a bit on automatic pilot and not used to research. So nevertheless, I was extremely happy to read the paper by Charles and Marius, and I know they're high caliber thinkers and very ambitious people, and I actually expected this paper to be a little bit more ambitious. Because I feel that I really enjoyed reading it. Just to summarize, I think I wanted to be a little bit more ambitious, and I will be more specific soon. By the way, I was not told about the award for the best discussant, so I don't know if I should change my discussion now, but that's all right. I'm kidding. Of course, we're not gonna let me influence, and besides, I only have nice things to say about the paper, of course. So this is one of my favorite topics, even though I haven't contributed as much to it, because it's about how the supply of and the demand of information. So how can you not be in love with this topic? And in particular, how do analysts choose which stocks to cover? And is there crowding of analysts in some stocks? And if so, how can we explain this crowding? And is that related to investors' attention, as the paper that we just saw is arguing? And so the topic is extremely important, and the contribution very nice. I think I have a few comments. I would like, as I said, the paper to be just a bit more ambitious and kind of get to the bottom of some of these questions. So like answer a little bit more to my liking, if you will. So we see that the stocks differ quite a lot in terms of the number of analysts covering. Stocks in the S&P 500 have a fair number of analysts. Those in the mid cap, fewer, and those outside, not too much. And in fact, some of them zero. So that's an interesting question. I used the picture by the authors from the slides. Of course, some of the cooler stocks have lots of analysts following, but the S&P 1500, the first 1500 stocks have about the median is 4 stocks, 4 analysts that cover. So it's natural to ask what is is there crowdedness and how do we measure it? So the paper starts with some stylized facts, and here it's normal that stocks with higher, with bigger size or higher institutional ownership will have more crowdedness. So you would like to look at some kind of residual. So you look at the coverage share, the number of forecasts for unique analysts as a percentage of all, you look at the residual with respect to some controls. And here, in some sense, it's a bit strange to do the stylized fact before the model, because here you would like to say, well, you kind of have a model of it, and then what is the residual to that model? But why should the model be linear? Why, for example, not use square controls? Of course, it's very natural to say, I'm going to look at linear controls and just look at the residual and see how, if there is crowdedness with respect to that. But maybe you also want to look at, I don't know, square controls. Who's to stop us from putting more things in the regression? I guess it depends if it's statistically significant or not, but just a question. But the model basically shows that there is excessive coverage. Perhaps the model, it depends on how you mean excessive. There's a difference between the empirical and the theoretical part. So if you look at, on the vertical axis, this is their figure 2. If you look at the vertical axis, it's a QQ plot. You look at the sample quantiles in residual coverage versus the uniform distribution, you see that indeed there's crowdedness, there's clustering. So there's a model which has 2 risky assets, number of investors with Cara preferences, and 3 stock analysts that choose one or the other, the stock with high precision or low precision, and then noise traders. Okay, so the main assumptions are that investors acquire signals about an asset, and they are independent signals. Investors have limited attention. This is similar to the Van Nieuwenburg and Velkamp, the restart paper, where if you, so here you just kind of take the sum of all the precisions, and that's limited. You can draw more precision from from the high stock, but then you have less precision in the low precision stock. Here, the contribution is that now there's a cost to learn about stock I, and that cost is inversely proportional to the number of analysts. In other words, if you have more analysts in a stock, it's easier for you to learn. Notice that even when you do learn, you learn with an independent signal. So that's an interesting assumption. And then analysts choose the stock I to maximize the investor attention. Okay, because and so the investor attention, as you see, has this cost here. So one kind of little question that I'm going to pose later is, do we need that cost over there? I understand that this is kind of a learning capacity, but I'm not sure that changes the result at all. But I guess specifications of these assumptions will be interesting to see if you change the assumptions a little, how this works. So the idea is here that you kind of share the investor attention. So this is the optimal kind of allocation of investor attention, but then you maximize, you kind of divide the attention by n, which is again an assumption. All right, so when I saw this paper, that's where the ambition kind of, I really want the authors to be a little bit more ambitious, because we talk about the demand and supply of information. And in particular, how exactly do analysts facilitate learning? That to me is the main question. I think the authors talk a little bit about this, but ex ante, when I thought about this, I just thought that analysts will produce some kind of independent signals. Buy, sell, hold. It's kind of a raw type of signal. So don't analysts generate some public signals that affect investor signals? Maybe the investors either interpret them or put them together with their own signal. But in that case, the investors' errors become correlated. So then the models kind of has to deal with the signals becoming correlated. So what I mean by being ambitious, can you solve the attention problem with correlated errors, which I know is challenging, but somehow it seems like this gets close to the heart of what analysts do and how that affects the investors. Now, what exactly is investor attention, and why should analysts maximize it? This is, again, I've keep asking this kind of fundamental questions because, why are the costs included in the investor retention? Why is the investor shared among the NI analysts? I just feel since this is during my teaching, I'm not sure I put 100% of my brain into interpreting this. So forgive me if I'm not understanding the paper as I should. So if analysts generate public signals and investors generate private signals, how does price informatives depend on the parameters? It would be nice, once you have analysts generate signals, you can also generate some additional predictions. So just leaving these assumptions aside, what is interesting about the paper, the main intuition is that strategic complementarity generates crowded coverage. So more analysts cover an asset, it's easier for investors to acquire signals about the asset. Although here, it's easier to acquire independent signals, which is a bit of a question mark if they can really acquire independent signals. But then investors allocate a larger share of their limited capacity to learn about better covered assets, and analysts have an incentive to cluster their forecast, therefore. But also, when less analysts cover an asset, they have a quasi-monopoly over the attention, so then you have an incentive to also choose neglected stocks. So which one dominates? And obviously, when investor attention is constrained, you get more crowdedness. And this is one of the main intuition, and very nice intuition at that. So just to conclude, I believe that it's a nice contribution to a great topic, and I would like to also be a great contribution to a great topic, which I sense that it has the potential to become. To my taste, the assumptions are a little bit too reduced form. So how exactly do analysts facilitate learning? Shouldn't they generate signals? If so, you would need to solve an attention model with correlated errors. What is investor attention? Why should analysts maximize it? And it would be nice to generate more predictions from the model in relation to price informativeness, which is also a cool topic. And empirically, then maybe more stylized facts and be more precise how we define crowdedness. Define it as an unexplained analyst coverage is a bit tricky because it assumes knowing the correct model, the explain part. I really look forward to the next version, and knowing Charles and Marius, I'm pretty sure they will dazzle me next time, but I'm waiting to be dazzled. Thank you.
Thank you very much, Ioanid. Marius, do you want to respond to Ioanid's discussion?
Thanks, Ioanid. This is a great discussion, and yeah, all the points are very well taken. We need to work more on this assumption and provide like a cleaner micro foundations for the investor, for the analyst maximization problem. Because we understand now it's a bit reduced form. So all in all, yeah, it's a great discussion. The correlated error problem, I'm not sure if it's going to change a lot of the main intuition in the sense, rather than just adding a bit more technical difficulty. But I think the part about the micro foundation is very well rounded. So thanks a lot. Thanks for all the time.